The outlook for the US dollar is more important than ever, as shifts in currency values can directly impact your investment returns, portfolio risk, and long-term financial planning. I'm Michael Sager, Managing Director and CIO of the Multi-Asset and Currency Management team here at CIBC Asset Management. I'm joined today by Eric Morin, Director of Global Macro and Strategy. Eric, good to see you.
Hello, Michael. Good to see you.
Our starting point today is the observation that the US dollar is expensive against a broad set of currencies. Overvalued currencies tend to revert back to their equilibrium, meaning that the dollar will weaken over time. But that weakening requires a catalyst. And for the past 10 years, in the context of US cyclical growth leadership and US equity exceptionalism, there just hasn't been a catalyst on the horizon. Today, things are changing, and we do think that a number of catalysts are now forming. Eric, over to you. Let's talk about the cyclical economic outlook that surrounds particularly tariffs.
Yes, Michael. So the first catalyst that will bring US dollar weakness in the next 12 months and over the medium term is the fact that the US economy will slow. One of the key drivers of the growth slowdown that we expect is a rise of tariff. The rise of tariff implemented by the US administration will be one of the biggest on record. Last time we saw a similar increase was nearly a century ago. So there is a big shock that will impact not only prices, but mostly demand. Why is that? Well, that tariff hike will have to be paid by somebody, and that includes the consumer. So the way we see tariff is that in the near term, yes, it will bring prices up, but it will also reduce demand. And over time, we do believe that the growth impact will outweigh the one-off impact on prices and inflation. And as a result, we do see an outlook in which the US economy will be slowing. That includes labor market, that includes consumption, and this should be enough for the Fed to resume its cutting cycle. So the Fed has been on hold with its policy rate for several quarters. It's been a laggard globally when compared to other central banks, which have cut a lot for several months and quarters. The Fed has remained a laggard, and we do believe that the tariff is the first catalyst that will hurt the US economy. And what's important to point out there is that the impact of tariff on the US economy is expected to be more important than in other countries. What we see is our estimated impact of tariffs on growth. And you can see at the bottom that the impact on the US economy is way bigger than the impact in other economies. And the other thing is that elsewhere outside the US, there's been a lot of stimulus that was put in place. So we have fiscal stimulus and we have monetary policy stimulus that should provide a cushion and certain tailwind. So net what we have is an outlook where US growth should be slowing and the rest of the world should remain resilient. And that should lead the Fed to cut by at least 100 basis points in the next 12 months. So net we have an interest rate differential that should narrow and that should provide impetus to other currencies. So this is really a headwind for the US dollar.
I think we agree that there's more going on than cyclical economic trends. And so, if you look at the heightened uncertainty around US policy implementation, including relating to tariffs, but also the combative attitude of the Trump administration towards academia, towards scientific research, I think that has also unnerved investors. And we can see the result of that. Here we've got two examples of correlations between the US dollar, returns to the US dollar, and returns to US treasuries on the left-hand side and US equities on the right hand. For both of them, the traditional relationship that typically holds between the dollar and bonds and the dollar and equities has broken down in 2025. And so that's indicative of an incremental change in the status of the dollar that's going on. So that's an important one, the attitude of investors to the dollar, which is negative for the currency. One of the themes on the chart on the screen now that I think is adding to that uncertainty, that nervousness related to the dollar is the increase in US debt. How important is that to the dollar, do you think?
This is another catalyst. Why is that the case? Well, the US is projected to have sizable deficit over the medium term. So we have deficit hovering between 6 and 7%. This is a big number, and this is twice larger than what we see in Germany, Japan, or Canada, or in most advanced economies. So as a result, the fiscal situation is something that should make foreign investors more nervous about an excessive reliance on US debt. So there is a lot of institutional investors, sovereign funds, and central bank that have in their balance sheet an excessive reliance on US treasuries, for example. Looking ahead, because of concerns on institution, because of the fiscal outlook, we do expect those investors to have a smaller appetite for US assets, mostly US treasuries. And why we care about that? Well, it's because the US has elevated twin deficits. So big fiscal deficit on one hand, and on the other hand, we have strong and elevated current account deficit. And the more a country has a big current account deficit, the more this has to be financed by foreign investment. So if we are in a world where it's going to be more and more difficult for the US to finance its fiscal deficit, but also its current account balance deficit, we should expect lingering headwind on the US dollar. So this is another catalyst that should bring or contribute to USD weakness over the next 12 months and over the medium term, compatible with the overvaluation, Michael, that you mentioned in the first slide, compatible with that overvaluation melting down in the next few quarters or over the medium term.
One thing I've emphasized, Eric, in the conversation is the word incremental. I think I've said it twice. And that's really important. You know, for the longest time, analysts have suggested that the status of the dollar will radically change overnight from the global dominant reserve currency to much less important. We don't agree with that. And if you look at the data on a broad swathe of cross-border transactions, the status of the dollar over the last 20 years, as the chart on the screen shows, really hasn't changed significantly. So I think it's important, the word incrementally, because that's what we're talking about, an incremental, gradual deterioration in the status of the dollar. But even incremental is going to be really important because it will lead to significant changes, we think, in currency hedging behavior of foreign investors. It will lead to changes in the relative returns of the dollar versus other currencies. So even though we're only looking for a gradual deterioration in the status of the dollar, that is important, and it will likely lead to a persistent trend weakening in the currency back to its fair value. Eric, I think we've covered a lot of ground there. Thanks for being here. Excellent insights as always.
Thank you, Michael.
So let's summarize our key takeaways. As we've discussed, the US dollar's future will be shaped by a range of factors. from economic growth and policy changes to evolving global sentiment, including towards US policy institutions. While the US dollar remains the world's dominant reserve currency, even incremental shifts in investor attitudes can have a meaningful impact on investment strategies and outcomes. Today, evidence points towards a sustained period of US dollar weakness, including against the Canadian dollar. This observation provides an opportunity for currency managers to add alpha to client portfolios with active positioning that captures this downtrend. It also provides an incentive for foreign investors in US equity to reconsider and potentially increase their strategic currency hedges. To stay informed with the latest insights and analysis, visit the CIBC Asset Management Insights Hub.